Hey guys, as the year's going to wrap up soon, the Federal Reserve just gave us a Christmas surprise in advance, a holiday twist. They have announced the rate cut on the 18th of December, just like everyone expected. It's a 25 basis point. But the big surprise is they are planning for fewer rate cuts in 2025 next year.
What does this mean for your money, your investment, and the market? Stick around and I'll break it down for you. Hey everyone, if you love quick updates like this, please hit that like button and subscribe to the channel. It really helps us to grow and bring you more content like this. Now, let's dive in. What happened? On the 18th of December, the Fed announced a rate cut of 25 basis points, 0.25%, exactly what everyone expected. This is the third time of the rate cut in the year. Normally, rate cuts are good news because cheaper money means cheaper cost of borrowing and businesses can grow faster. But here is the twist. The markets has already priced in this cut. Things are already expected and therefore the stock recently hitting all-time high. Now for the catch. The Fed signaled a much more cautious stand for 2025. Instead of 4 rate cuts the market were hoping for, they are now projecting just 2. And the latest dot plot from the central bankers, compared to what was released and forecasted back in September, shows that rates in 2025 could be just half of what was initially expected. This shift is quite significant, and the change of outlook created market uncertainty and triggered a massive sell-off. The result? Market tank. The Nasdaq has been down by 3.5%, S&P 500 down by 2.9%, and Dow Jones down by 2.5%. And all of that happened in just one day. Everything was red. Okay, now let's come back. Why the Fed make this move? Let's set the scene. Firstly, the Fed always have its own objective to control inflation, to ensure steady economic growth and protect the job market. In November, the inflation rate rose slightly to 2.7%. This is still higher than the Fed 2% target. In terms of job market, unemployment rate is around 4.2%, higher but still healthy. Economic growth-wise, the economy has been surprisingly strong this year, with the stock market hitting all-time high. So why fewer rate cuts in 2025? The Fed is focused on keeping inflation in check. They are just being cautious about cutting rates too quickly, too aggressive may cause high inflation, especially during this time of global uncertainties and the rising geopolitical risk looming large. As you know, what is new in 2025? Let's add the political angle. Donald Trump is expected to take office officially in January 2025. Trump economic stand. Historically, Trump has always supported tax cuts for businesses and deregulation to boost economic growth. These are good for businesses. And if he follows the same playbook, which is likely to happen based on what he promises during the election campaign, we could see stronger business sentiment and increased consumer spending. Second, Federal Reserve and policy clashes. Trump administration may push the Fed to cut rates more aggressively. However, the Fed cautious stand suggests they will prioritize inflation control over short-term growth, resisting political pressure. It is likely that Jerome Powell will stay in the position for a while. Additionally, tariff might make a comeback. Trump has hinted a 10% tariff on all imported goods from its trading partners like Mexico, Canada, China. This is the danger. This could increase the cost for businesses and then pass on to consumers, creating further economic challenges. In terms of economic projection, even the Fed chair, Jerome Powell, admits it is nearly impossible to predict the economic path 3 years out, leaving plenty of uncertainty. That said, many officials expect unemployment rate to stay steady at 4.2 to 4.3%, signaling a strong job market next year. This stability might reduce the need for aggressive rate cuts. Overall, steady economic growth paired with persistent inflation is likely in 2025, keeping the Fed cautious in its approach. What this means for you? Here's the big questions. How does this rate cut and the signaling affect your money? Well, for investor, it is clear that the market tanked because of the slower growth projection. It is important not to expect a straight line return. Markets have good years and bad years. So just diversify your portfolio with value and quality stocks, or maybe you can focus on dividend paying stocks that can give you the income. Be patient because volatility is just part of the game. For businesses, the plan for slower rate cuts is obvious, indicating the borrowing cost could be higher than expected in 2025. So focus on efficiency and reduce unnecessary borrowing. If your business has high debt, look for ways to manage the interest rate risk. For everyday folks like you and me, the borrowing costs like mortgage and loans might stay higher for a longer period. There may not be more rate cut next year. So if you are planning any big purchases, budget carefully. While the December rate cuts feel like a gift, 2025 won't bring rapid rate relief. This means the economy will keep walking the tightrope between growth and stability, and it all depends on the incoming data like inflation, unemployment. My take from this is don't panic if the market pulls back. It is normal. Historically, good years followed by bad years and vice versa. Yes, the stocks are still expensive right now, but timing the market is impossible. So just stay focused on the long term. Thank you for watching this video. As we head into the new year, staying informed is key. Whether you are an investor, a business owner, or just curious about the economy, understanding the Fed move can give you an edge. Thanks for tuning in and happy holiday. If you haven't subscribed, do consider and support our channel to grow. See you again.